The crypto market has entered one of its most uncertain phases in months. Bitcoin's momentum, once filled with optimism and energy, now feels like it's hanging by a thread. The euphoria that followed the ETF approvals and institutional inflows has faded, leaving investors questioning what comes next. As prices drift toward the $100,000 zone, the mood has turned anxious. There's still hope among long-term believers, but even they sense that something isn't right. The market seems heavy, slow, and confused, a reflection of the wider global mood. It's strange how quickly the excitement has vanished. Not long ago, headlines were celebrating record highs and endless growth. But now the same analysts are warning about a correction that no one wanted to believe was coming. The charts show what most traders already feel: a loss of momentum. Each rally is weaker than the last, and every bounce fades faster. Bitcoin still trades above six figures, but that number feels fragile, as if it's being held up by hope rather than demand. When a market runs out of catalyst, it starts to drift, and that's exactly what's happening now. After months of talk about ETFs, institutional adoption, and liquidity flows, there's nothing new to keep the excitement alive. Prices are not collapsing, but they're not climbing either. It's a slow grind that frustrates both bulls and bears. Retail investors have started pulling back, tired of waiting for the next breakout, while professional traders seem content to wait on the sidelines. The result is a flat, uneasy silence. This is what consolidation looks like. Long periods of sideways movement where conviction weakens and fear quietly builds. The recent dips toward $100,000 triggered waves of panic selling, but underneath all that noise, the market is simply catching its breath. Still, the silence doesn't feel comforting. It feels like the calm before a storm. The trouble isn't just inside crypto. The global financial system is struggling to find balance. The US government shutdown is a perfect example. It's more than a political argument, it's an economic roadblock. When government operations freeze, spending halts, paychecks stop, and consumer confidence collapses. Since government spending makes up a large share of total economic activity, that kind of pause sends ripples through every sector, from retail to tech to crypto. The strange part is how little mainstream coverage it receives, almost as if everyone wants to ignore the danger. Bitcoin is extremely sensitive to liquidity. When government workers aren't getting paid and public spending slows, the flow of money across the economy tightens. That tightening leads to less risk-taking and smaller inflows into speculative assets like crypto. The Federal Reserve isn't helping either. Interest rates remain high, and central bankers seem more concerned about inflation optics than the damage these rates are doing to small businesses. Many small and medium-sized companies can no longer access cheap credit. Overnight borrowing costs have shot up, and banks are being extra cautious. That affects hiring, investment, and consumer activity. And all of that eventually feeds into market sentiment. The irony is that while the Fed talks about being data-dependent, much of the data they rely on will look worse precisely because of these policies. The feedback loop becomes brutal. Higher rates slow the economy, weak data triggers fear, and investors pull back even more. Big tech firms like Meta and Google are still raising debt because they can afford to, and their stocks keep the indexes alive. But that's a mirage. Beneath those few giants, the broader market is fragile. The S&P 500 looks healthy only because of a handful of names. Strip them out, and you find weakness everywhere else. That imbalance matters for crypto because it mirrors the same story. A small part of the ecosystem doing well while the rest struggles to stay afloat. For Bitcoin, this is the hardest kind of environment. Not an outright crash, but a slow erosion of confidence. Around the $100,000 mark, everyone is second-guessing their strategy. Traders who bought early are tempted to take profit, while newcomers who entered late are starting to panic. The selling pressure builds quietly. Every small drop triggers another wave of exits, and yet every time there's someone willing to buy. That tug of war defines this phase. Institutional investors who were once seen as Bitcoin saviors are no longer rushing in. The ETF moment brought legitimacy, but not endless capital. Now those same funds are cautious, adjusting allocations while waiting for clearer signals from central banks. For them, Bitcoin is not a daily trade. It's a long-term play. But for retail investors, patience is running out. Many feel trapped, too afraid to sell, too tired to hold. Altcoins are suffering the most. Whenever Bitcoin stops moving up, smaller coins start collapsing. The liquidity dries up and speculation fades. Retail investors used to chase big percentage gains in tokens like Solana or Avalanche, but that excitement has evaporated. Institutional money isn't rotating into those assets, and venture-backed coins are becoming exit liquidity through ETFs or token unlocks. In simple terms, the big money is protecting itself while retail gets squeezed. Even so, this phase doesn't necessarily mark the end. Historically, periods like this, marked by exhaustion, boredom, and disbelief, often set the stage for the next major move. But timing that move is nearly impossible. Those who survive it are usually the ones who can sit still while everyone else panics. Everything now depends on timing and policy. If the government shutdown drags on, liquidity will continue to shrink, and markets will likely sink further. If a resolution arrives, spending resumes and data improves, sentiment could stabilize. The Federal Reserve also holds a major key. Despite public statements about keeping rates steady, the pressure to pivot is building. When the economy visibly weakens, when unemployment ticks up, and when businesses start defaulting, the Fed will be forced to act. A rate cut, even a small one, could change everything for crypto. If rates start falling and liquidity returns, Bitcoin could easily recover from this slump. The digital asset thrives on loose money and low fear. A softer Fed would mean a weaker dollar, and historically, that's when Bitcoin shines. But if the Fed hesitates, trying to appear tough while the real economy bleeds, the market could endure more months of pain. The good news is that this pain cannot last forever. Economic cycles eventually force a response, and when that response comes, Bitcoin usually benefits first. Until then, patience is the only strategy that makes sense. The market is messy, unpredictable, and often manipulated by fear. Every time headlines scream, crash or collapse, it's worth remembering that the same people panicking now will be buying again when the recovery starts. Bitcoin's story has always been one of volatility and resilience. It breaks down, it rebuilds, and each cycle brings a new generation of believers. Right now, the data points to weakness. That's the truth. But weakness is not the same as death. The ecosystem is still alive, the technology still works, and the long-term thesis hasn't changed. What's changing is sentiment, and sentiment always moves in waves. The next wave of optimism will come, but only after the fear runs its course. For now, the smart move is awareness, not panic. Watch the macro picture, follow liquidity, and remember that every dark chapter in Bitcoin's history has been followed by a brighter one. This is Think Crypto, reminding you that markets don't move in straight lines. They move through storms and calm waters alike. What matters is not predicting every wave, but understanding the tide.